Small cap stocks tend to outperform the broad market over the long term. However, during crisis periods and recessions, they also tend to crash more. What makes them attractive right now is the fact that they've got a low valuation relative to the rest of the US market. So in this video, we look at indices for small caps, but also the funds which track them. And then we'll consider the risks that go with small caps. Now, if you do enjoy our content, please do subscribe to our channel. That way you won't miss any new content. So let's look at the best small cap funds in a bit more detail. Before we talk about small caps, we have to understand what we mean by cap, or market capitalization. This is a single number which captures how much stock capital exists for a given company, and it's simply the number of shares multiplied by the share price. So to take an example, if we look at Apple, you can see it's got about 16 billion shares outstanding, and if we multiply by the share price as I make this video, which is about $160, we multiply the two together and we get $2.5 trillion. So that's the market capitalization of Apple, and it's the largest stock in the world by market cap. So that's a mega cap. So if that's the definition of market capitalization, now let's turn to small caps, the tiny companies. If we take the entire US stock market and we break down the stocks according to their market cap, you get this distribution beside me. Notice that on the x-axis we've got a log scale. So we've got about $1 trillion market cap, so those are the mega caps, with Apple on the far right, and then on the far left, all the way down to 0.01 billion market cap, for the absolutely tiny stocks. And most of the stocks that you can see here in the US are clustered just above the 1 billion mark. So you can also see these vertical dashed red lines, and these are the kind of cutoff points for the different types of US stock. So everything up to about $250 million market cap would be considered micro caps. These are really teeny stocks. Everything between 250 million and 2 billion would be considered small caps, which is the focus of this video. Then between 2 billion and 10 billion is mid cap, and then between 10 and 200 billion are large caps. So the S&P 500, for example, is mostly those stocks. And then finally in the US, we have a new category, which is mega caps. So those would be companies like Microsoft and Apple, which are absolutely huge in terms of market cap, reaching all the way above $1 trillion. Now, I said in the intro that small caps have outperformed over the long term. Let's take a look at that. Now, the Bogleheads Forum has a brilliant spreadsheet called the Simba spreadsheet, and this is data taken from that. And what it shows you is the total real cumulative return, so it's adjusted for inflation, and we've reinvested dividends for 3 indices, 3 funds. The one which has performed best over the period since 1970 is US small cap stocks. Those have on average returned just under 7%, whereas total US stocks over the same period have returned 6.3% and global stocks 5.3%. Now the question is, has that outperformance been steady over time? And the answer is no. So if we take the ratio of US small cap blend, which is that small cap index which we just saw, and we divide it by the size of the total US market fund, when this number goes up, that means that small caps are outperforming. And certainly over this period since 1970, that has been the case, but it's also not been a smooth ride. You can see this huge period of outperformance in the late 70s and early 80s, but then it crashed again, surged, crashed again, and then we got a secondary surge after 2000. Now, during the last decade, you can see small caps have underperformed, but that's part of the reason why their valuation right now looks attractive. To get diversified small cap exposure, you need to choose an index which contains them. So what I've shown here is a selection of indices, some of which are small cap indices, some of which aren't, just so that you can compare the range of market cap for the stocks contained in the index. Now notice that at the bottom we haven't got a log scale, and I showed this just to show how the US is disproportionately bigger than other markets in terms of market cap. You can see that the S&P 500 goes all the way to the mega cap range, here above $3 trillion. Another large cap index, the Russell 1000, also dwarfs all the other indices, including all 3 of these from the UK, which are almost invisible on the graph. In order to see these ranges better, we have to use a log scale. And here's what the same data looks like if we do that. So the top three ranges you can see here are for the US S&P 500, that's US large caps, US mid caps, that's the S&P 400, and US small caps, that's the S&P 600. Then we've got two more indices for US stocks from Russell this time. The Russell 1000, that's large caps, the Russell 2000, that's small caps, and for a bit of context, I've shown the UK market. The FTSE large cap index, the FTSE 100, the FTSE mid cap index, the FTSE 250, and the FTSE small cap index. But for now, let's focus on those US small cap indices. Notice that the range of market capitalization is much larger for the Russell 2000 than it is for the S&P 600. As we'll see in a moment, that's partly because the Russell 2000 is less selective in its choice of small cap stocks. So here are the selection criteria for the S&P 600. And the key one from the point of view of an investor is the financial viability filter. Companies that make it into the S&P 600 have to have positive earnings. In other words, they have to be profitable. That's over the most recent quarter, as well as over the most recent 4 quarters summed together. So whereas the Russell 2000 contains unprofitable stocks as well as profitable ones, the S&P 600 is filtered to just allow for profitable stocks. So if you do want to ensure that quality filter's in place, the S&P 600 might be more appropriate for you. Why are small caps interesting right now? Well, it's to do with valuations. If we look at the forward price to earnings multiple, that's the price of the index divided by the forecast earnings for the index, or profits. The top panel here shows you the small cap index for the United States, the S&P 600. And the horizontal line that you can see, the red one, is the typical or median valuation for that index. Now at the moment it's quite a long way below that average. In other words, small caps look cheap. They're trading at 12.9 times forward earnings. Whereas if we look at US large caps, the S&P 500, those are actually above their median. So those aren't particularly expensive, but they're definitely not looking cheap. Now small caps aren't as cheap as they were during the pandemic sell-off or during 2008, but still relative to the rest of the US market, they are looking quite attractive. And what that usually means is higher returns going forward. And we can also illustrate that by looking at single US stocks. Again, I've broken it up on the x-axis into micro, small, mid, large, and mega caps. And on the y-axis, I've got the forward price to earnings multiple. And each dot on this graph represents one US stock. So you can see the mega caps here on the right-hand side and the micro caps on the left. And I've smoothed the average as we go through different market capitalizations. Notice that that line is upward sloping, such that small caps and micro caps are cheaper than mega caps and large caps. Why might that be? Well, these stocks are simply more sexy and also more recognizable. I dare say you're not going to recognize many of the stocks here in the small cap and micro cap range. Another reason why small caps tend to outperform, some people think, is because institutional investors just can't buy them. If Warren Buffett were to buy one of these small caps to get meaningful exposure, he'd just have to buy the whole company. So these are out of reach of institutional investors, and that means they may have some risk premium which doesn't get harvested. Another reason people think they outperform is because they're fairly illiquid. The bid-offer spreads are wide, and that makes them harder to trade and more expensive to trade, and you get a premium for having that illiquidity as an investor. What are the risks of small caps? Well, if we are about to enter a recession period or the banking crisis escalates further, then small caps will be the stocks which suffer the most. Remember, these are tiny companies with domestic exposure mostly, so these will have weaker balance sheets and they're less likely to survive a crisis. What we've also seen recently is tightening of credit conditions. Remember, these small companies don't usually get funding via the corporate bond market. They'll usually do it from a bank loan, and banks are getting much more fussy about who they take risk by lending to. If there's less credit availability, that also slows down the growth of these companies and slows down their share price growth. And also, they're just more volatile. If you look at the volatility of small caps versus large caps, you'll see that the price is just more wiggly. it's also more crashy. So if you are going to buy these, be prepared for a rough ride. It won't be easy. And the credit conditions could be a big deal. So at the latest FOMC meeting, Jerome Powell actually said that what's happening among the banks is that there's going to be some tightening in credit conditions. And in fact, the Fed's thinking about that as effectively doing the same thing that rate hikes do. So this tightening in bank lending is effectively becoming like a rate increase, but one which I think will disproportionately affect small caps. Now, in a moment, I'll show you some of the cheapest small cap funds, but if you're a member of PensionCraft, you get access to a database of some of the cheapest and best funds in every category, including small caps. So what's the cheapest multi-asset fund? What's the cheapest global equity fund or commodity fund? You also get access to Slack and a growing library of members-only content. So if you do want to learn more about our membership, just look in the link in the description beneath me, or go to our website, pensioncraft.com. Now finally, let's look at some of those small cap funds. In Europe, Just ETF offers you a selection of ETFs for every category, including small caps. So you can see that the cheapest S&P 600 tracker is the one from Invesco. The fee for that is just 0.14%. In the US, Vetify offers an equivalent database. Notice that the expense ratio for US investors is well below that for European investors. And I haven't shown you the whole list here, just the top 5, ranked by expense ratio, and it's a lot longer than it is for European investors too. So in the US, Schwab US Small Cap is the cheapest ETF for small caps. Now a secondary consideration might also be which index it gives you access to. If you do want that quality filter, then I'd prefer the S&P 600 over something like a Russell 2000 tracker. If you're not worried about profitability, then that wouldn't be a consideration. But it is always worth digging into each of these indices to see exactly what it gives you exposure to ensure you're happy with it. So if you are thinking about buying small caps, just remember it's going to be a rough ride. We are entering a choppy period. If the banking crisis escalates, or if there is a big recession in the US and elsewhere, small caps will probably suffer more than the broader market. But certainly the valuations at the moment make it look attractive, and I've certainly bought it as part of my fund portfolio. Now don't forget our offer. If you do want to become a member, then you can learn more about that at pensioncraft.com, and there'll be a link in the description beneath me. And as always, thank you for listening.